Multiple time frame backtesting is one of the simplest and most efficient forms of robustness testing. Here I will explain why you should do it and how you can do it using MT4 and StrategyQuant.
Market structure often changes significantly when viewed on different time frames. Here's a snapshot of the dollar-yen on the 15, 30, and 60-minute time frames. By changing your backtest time frame, you can conveniently perform an out-of-sample test that evaluates your strategy's insensitivity to changing prices. A robust strategy that remains profitable across multiple time frames will likely adapt better to changing market conditions in real time. Short computation times. As much as possible, structure your workflow such that the fastest tests are performed first. This can save you a huge amount of computation time if you're evaluating a large pool of potential strategies. The faster your strategy development, the sooner you can trade with real money. Multiple timeframe backtesting is very efficient and is a great choice for an early robustness test, before other popular but more stringent robustness tests like walk-forward optimization and Monte Carlo simulations. Unlike backtesting on multiple markets, you also won't need to download additional data. Not all timeframes are created equal. Here are 3 things to keep in mind. First is the effect of noise. Noise is random price movement that is unrelated to any underlying trend, and is an unavoidable consequence of the millions of traders transacting for different agendas. Your price feed will contain higher amounts of noise on the lower time frames. If you're testing a trend-following strategy, the scarcity of smooth moves on the lower time frames will hurt your performance. For example, if you developed a trend-following strategy on the 1-hour time frame and tested it on the 1-minute time frame, you're almost guaranteed to see long strings of losses. Conversely, mean reversion strategies are good at exploiting temporary overextensions caused by random noise, so performance will likely suffer on the higher time frames. Next, have a look at your strategy elements. If you use volatility-based entries and exits, your strategy may adapt better to different time frames. A common adaptive element is the ATR-based stop loss. For example, if you place your stop 3 ATR from your entry price, your actual stop distance, in pips, will automatically increase as you progress to the higher time frames. This isn't the case if you use a pip-based stop. A 20-pip stop may work well on the 15-minute time frame, but will be too tight on the 4-hour time frame. Lastly, pay attention to your backtest sample size. In general, you want your backtests to contain as many trades as possible. Your backtest standard error is inversely proportional to the square root of the number of trades. A large sample size creates a smaller standard error, meaning your backtest results are more reliable. When you backtest your strategy on a higher time frame, for example going from the 30-minute to the daily time frame, you're going to see a drastic reduction in number of trades. It's for this reason that I never develop strategies for the daily time frame, since it's difficult to get a large sample size, even with 20 years of historical data. With these 3 considerations in mind, I generally only backtest on the next higher and lower time frames. With that said, let's go ahead and test the 30-minute dollar-yen strategy on the 15 and 60-minute time frames. Let's start with MT4. On the original trading time frame, the strategy has a smooth equity curve with a 1.38 profit factor when tested from 2003 to 2022. To run the robustness test in MT4, you only need to change the period field. Once you have your backtest reports, I recommend importing them into Quant Analyzer. You can overlay your equity curves as shown, and obtain more detailed metrics. If you're backtesting in StrategyQuant instead, you have the option to partition your data into multiple segments and apply automatic performance filters to each segment. This helps you quickly focus on strategies that have performed consistently well over the historical period. For this example, I'll partition the 18-year backtest into 2 equal segments. Now head over to the Cross-Checks tab and select the Additional Markets check. Set up the additional backtests as per your time frame of choice. Under the Filtering tab, I will set up 2 filters to apply to each data segment. As a simple gauge of profitability, each 9-year segment should have a minimum profit factor of 1.1. For some statistical significance, each segment should also produce at least 30 trades. This test is a verification of your strategy's performance on the original time frame, so I consider a measly sample of 30 to be a fair trade-off. I wouldn't want to discard a strategy simply because it has too few trades on a higher time frame. So does the strategy pass the robustness test? Performance deterioration is within expectations, with each time frame meeting the profit factor and sample size requirements. the equity curves still display a general uptrend without deep drawdowns, so I would consider this a successful robustness test. So if you're looking for a simple and efficient robustness test, do give multiple timeframe backtesting a shot. It's a great way to kick off your robustness testing workflow. If you want to learn about walk-forward optimizations, check out the video at the top right. If Monte Carlo simulations are your thing, check out the video at the bottom right.